Hello everybody and welcome to the Cyclical Investors Club YouTube channel. Today I'm going to be taking a look at Fortinet stock. I've had several requests for this one and I have owned this stock for a while now. So I'm going to examine it today. If you have a request that you would like me to take a look at and it's in the S&P 500, just drop it in the comment section and I'll put it on my whiteboard behind me here and eventually I'll make a video of it. If it's not in the S&P 500, I post those videos over on Patreon, which is $5 a month. And then you also can get a big discount if you join there over to the full Cyclical Investors Club service over on Seeking Alpha. And there I have chat room, spreadsheets. You can look all the stuff that's in most of these videos. You can actually just look up anytime or ask me anytime and I'll get right back to you rather than having to wait for me to make a video. And then I also have larger strategy things there, lots of different articles on various topics, and it's basically like a full investment service club. So consider checking that out. Those links will be in the description. So I bought Fortinet stock using a growth strategy, like a growth stock strategy that I have in the full Cyclical Investors Club service. Now, all the details of that particular strategy are exclusive to the service. That's one of the, I don't really write about them publicly, but I do sometimes, like, I'll let people know that I bought something, which is kind of the case here with Fortinet. I bought it using that growth strategy, let's see, on May 10th, 2022. Now, if you're familiar with any of my other strategies and analysis, I'm pretty conservative. I like to have a good combination of growth and in terms of like earnings growth or potential cyclical growth. But I also like to buy stocks when they're very cheap. So, and I can be very, very selective with my two core strategies that you see me talking about in my videos and in my public articles all the time. Because those strategies are pretty strict, there is kind of a gap in my strategies where a company like Alphabet probably would never become a buy using any of those strategies, but they could still do really well over time. They could earn like 15% earnings growth a year, but even though they always kind of trade at like a premium. So it would never get cheap enough for me to buy. So my growth strategy is designed to buy stocks like that. And it's also designed to buy like really early stage businesses that have maybe IPO'd 2 or 3 years earlier. And maybe we get a chance to get on something that's before they really have much in the way of earnings. My other strategies are primarily I judge the companies based on their earnings, like their historical earnings. And so if you have a company that doesn't have a lot of history, then you need a different type of strategy. And that's the other type of stock that my growth strategy is designed to try to capture. Fortinet would be more like the Google story, where it'd be like they were already pretty big. They probably have the same market cap now, actually, as when I bought them. So about, we'll call it 40 billion in market cap. So I mean, a 40 billion, it's much harder for them to 10x than it is for a $4 billion company, just by pure size considerations. But you can still do really well and you can pay more for them as long as that growth lasts a long time and is a pretty high, usually like 20% is kind of the threshold that I usually aim for. But if they can do 15 for a really long time, like 15 years, then that will eventually that'll work itself out too. So I'm going to talk about this from the perspective of earnings, but earnings were not what I was looking at when I actually bought the stock. But we can look at it from an earnings perspective too. But I just want to give everybody like some context of kind of what's going on. So I bought this one. Let's see. I have 5/10/2022. So it might have been during this. Yeah, it was during this sell-off right here. And then it's basically flat now. It's kind of been, let's see. So we had a nice run here, but we're back down pretty much to where we bought it. I think it's almost exactly even, actually. So But what I wanted to point out here was when I bought it, the PE was nearly 60, and now the PE is half that. So even in the last year and a half, the stock price is in the same spot. The earnings have grown enough to bring that PE basically almost in half. So the fundamentals are actually working out okay, given the idea that I hold the stock for 10 or 15 years or more. So they're closing that multiple pretty quickly, which is good. Now, the problem and the reason the stock is sold off from up here, I mean, other than that it was just kind of expensive, is that relative to that PE, analysts are expecting earnings to slow down like considerably. So if we, I don't know if fast graphs will count. We'll just go from 2015 to there. The earnings growth was 36%. That was the earnings growth rate. And now we're looking, I don't know, if you average that somewhere in the mid-teens, we'll say. Mid to low teens. Now, analysts can be wrong. They could be worse or they could be better. We don't know. And so that's the question you really have to ask yourself. I don't have a great answer for that. But I do know that they did have like a spike in earnings with COVID and things related to that. So we do know that, but they had great earnings growth before that. So I don't think it's fair to attribute all of their earnings growth during this period to COVID and COVID stimulus and so forth. So the question is their last earnings report. I usually, once I buy a stock like this and it's not really an earnings based one, just when I'm checking up on them to see kind of how they're tracking, I usually just glance at the revenue growth from their earnings report, and theirs was about 16%. I usually like that to be over 20. So even for me, they've and even though earnings have been fine, you can see that there's a trend there where that revenue growth is below like the 20% I would like to see. And they could slow down for a while, or we don't really know what's going to happen. But that is why the stock has sold off. Now, it still has a 33 PE. It has a great earnings growth history. It's a pretty high quality business. You don't have to, there's no debt or anything to deal with. So what it boils down to is, this is kind of what it always boils down to, but even from the time that I bought until now, we've had the multiple compression. So we got that initial growth that you need to get when you pay that much for a growth stock, right? So the initial growth is there. And the question is, what kind of growth are these guys going to be able to have longer term? And I guess for investors considering whether they want to buy right now, this next year could be important too, because if earnings come in like slightly negative, if they just have a down year, which happens sometimes. I mean, they had a down year in 2017, right? Then that will almost certainly send the stock price lower. And we don't really know exactly what that's going to be, or exactly what the market's going to be looking at. Maybe if it is bad, some of that's priced in, and then the market starts looking forward. So we don't really know. You just have to ask it. So for me, I just say what's reasonable and also somewhat conservative if we're looking at this from an earnings perspective for these guys to actually grow at. And right now, with revenues growing mid-teens, I mean, I think like a 15% earnings growth rate is probably not too optimistic, but not too pessimistic. So we know that they've been growing fast. We know they're probably going to slow down for a little bit, but they could easily pick that growth back up. So, and I don't think anybody really knows what's going to happen 2 years from now or 3 years. But you have to make an educated guess with a growth stock that there's a reasonable chance they can keep that going for quite a while. So to put this all together in a shorthand way, if I was looking at this and I said, okay, they're going to be able to grow 15% from here, grow earnings 15%, like a 20-ish PE is okay to pay for that. Like that would be a good price, I think. And that would be about $35 per share. So even though I own this one, I think assuming a 15% earnings growth rate, buying at $35 per share is a decent bet. even if they miss earnings next year. Like even if, because the idea is, look, there's some fundamental thing that they're doing here that they can keep eventually doing, and even if there's some ups and downs, right? So that would be a good price, I think, to take a shot at it. Another way to think about it is if you think maybe growth could be faster than that, even if they have a down year, use some sort of momentum or technical factor to help you buy it. And then usually I don't like to pay more than about a 30 PE if I'm assuming 20% growth, which is actually where I max out all my assumptions. So for an earnings-based stock, obviously I paid more than that there, but I wasn't using earnings, which is pretty close to where the price is now. You know, maybe we call it like 48 to 50, maybe a little bit lower. So you want it to have like a 30 PE, but you also want it to have some signs that there's a bottom being put in. And that can help if it doesn't fall all the way to like the $35 a share. So maybe it falls to $40 a share, but it puts in like a double bottom and it breaks out and the momentum breaks out and it's now at $45 a share. Well, that could be okay. If you think off that bottom, wherever earnings come down here, if you think they can grow like 20% off that, then that would be a way to go about it as well for the long term. And then I take small positions like 1% weightings, 1 to 2%. And this is the type of stock where you really, it's going to be a long-term thing. You just buy it, let it go. Like I'm not selling my position. And I'm not even telling anybody to buy at the same price I did. I'm saying, you know, probably a little bit lower or to some kind of bottom is where, if I was just coming in with new money based on earnings, that's what I would try to do. And I think you can get, I think that's a fair way to play it. And then you just have to hold on and say, okay, let's and see if the company can do it or not. And that's why you don't take like I don't take giant positions, because you don't know. Some of these companies are going to do well, some are just going to do okay, and then some are going to do poorly. But most of the time, if you get something that has a good history, good fundamentals, and it's just coming down to growth, a lot of times they can find ways to do at least okay, and then if you get a winner, and then you can do really well. So that's the idea here. So yeah, I would say $35 a share. It looks pretty interesting, assuming 15% earnings growth. And then if you want to assume a little bit faster, up to 20%, perhaps 20% off of whatever this bounces off of, and you see the stock making some kind of a bottom and breaking out, and then those two things together could be like, okay, now's the time to go. And I wouldn't pay probably more than where the stock is now. That'd probably be like the peak, basically what I paid. I don't think I would pay too much more than that. All right, that's it. It's pretty simple. I don't have all the calculations that I normally do. These actually are similar to those because I don't track this one on an earnings basis since I had already bought it. But just a way to think about a growth stock, accept the things that you don't know, and try to get the ones that have the profile that can potentially do well. All right, if you enjoyed this video, found it useful, click the subscribe button, and I'll have more videos coming out soon. Later.